Hi, thank you all so much for being here today. My name is Phil Goldfeder. I'm the CEO of the American FinTech Council, but you did not come to hear about me. We're excited that you've been able to join today, the Future of Finance webinar series. We bring to you great conversations on different diverse topics related to FinTech and financial services every single month, but I am truly excited about the response we've gotten to this one, and more importantly, not just about the topic, but most importantly about the people who are going to be presenting. Of course, to our amazing friends at Davis, Wright, Tremaine, Bradford has been sort of initiated our relationship a long time ago, and since then I've become friends with nearly half the law firm, I feel like, and Chava, who's you're going to hear from today, has sort of been a leader on some of the work we've been doing in Colorado related to their options, and you're going to hear more about that. But Sharity Nichols, again, sort of new to the American FinTech Council ecosystem, has sort of been a vocal and visible leader sort of across the FinTech lending and the online lending community. And then, of course, I mean, David Durant is a man who literally needs no introduction. Is sort of been leading the charge on a lot of our work related to earned wage access. So this is going to be an amazing conversation. I'm so happy everybody is here to join. And with that, Bradford, I'm going to turn it over to you.
Yeah, thanks, Phil, for the intro. Gracious as it was. We're very happy to have a bit of time this afternoon to present to the AFC membership and friends. It's no secret, of course, that we're in a period when the federal regulatory apparatus is in a degree of drawdown or drawback, if you will. And one of the things that I think everyone on this call, at least on this panel, agrees about is that we have already started to see a number of states move in to fill the gap, so to speak. We will talk a little bit more about a few different topics under that general theme. But before we do, I want to give folks an opportunity to introduce themselves. As Phil suggested, my name is Bradford Hardin. I'm a partner in the DC office at Davis Wright Tremaine. My practice focuses on consumer finance and payments, regulatory advice and counseling, and enforcement matters. And we'll go in order, perhaps, of people as they appear on my screen. Chava, that puts you next.
Everyone, I'm Chava Brandriss, as Bradford says. I'm a partner here with him at Davis Wright Tremaine, also focusing on banking and consumer financial services. As Phil mentioned, I'm a litigator. I'm also sometimes an enforcement defense lawyer, as well as a regulatory advisor, all in this consumer financial services space.
Sharity.
Good afternoon. I'm Sharity Nichols, and I'm the Deputy General Counsel at Avant. I manage the legal regulatory team, which includes consumer litigation, legal support of product, and our risk teams, including compliance, BSA fraud, and enterprise risk management, as well as privacy and information security support.
David?
Good afternoon, everybody. Excuse me, and delighted to be with you all. Briefly, I have been a practicing lawyer for longer than I'd like to admit. I've got 20 years in consumer financial services across multiple in-house jobs, and also have had the joy of working on compliance and government relations things in addition to my legal roles over time. So looking forward to having the conversation today.
Awesome. Thanks, David. So as I was suggesting, we are seeing a number of different ways in which the state attorneys general and state financial services regulators and state legislatures are stepping into what some perceive to be a void that is being created at the federal level in the areas of consumer finance. And there are a number of examples of those that we'll talk about. One that is top of mind for this audience in particular is something called the true lender doctrine. Sharity, turning first to you, could you tell us what issues and actions you're monitoring at the state level in the area of true lender?
Yes, so we closely monitor state level actions related to the true lender doctrine, especially in jurisdictions that historically challenge or scrutinize the bank fintech partnerships. But in 2025, I would say our monitoring efforts have become even more focused on proposed legislation and regulator guidance and policy statements relating to licensing requirements, usury, and DMCA opt-outs. For licensing, we are monitoring just shifts in licensing expectations, whether that's through formal rulemaking or policy statements. I think a good example of this is the recent Ohio DFI's guidance concerning the Small Loan Act. On usury, we're not just tracking statutory rate caps, but also amendments to anti-evasion provisions, which often times may be written broadly, which of course then introduces certain legal uncertainty that we have to try to interpret those proposed amendments. And then on the DEMICA front, we view opt-outs as one of the most material developments. So when a state opts out, it effectively removes that federal interest rate preemption for state chartered banks. So overall, these specific, these true lender areas directly affect the bank fintech partnership models. So they demand attention and proactive strategic planning.
So this is an area that, at least from my vantage point, over its history has been, one where enforcement and litigation were the primary tools by which the doctrine was developed. The way that you focused on legislation and policy statements in your remarks indicates to me that maybe that the tenor of that is changing. Would you agree that we're at the state level moving towards more of a prescriptive or legislative and regulatory approach to true lender, and maybe somewhat less towards enforcement as a tool, or is there not a trend there? What do you think?
Well, I think it's a little bit of a wait to see. It appears that that is maybe the direction it's moving in, but I think it's still too early to tell. So I think that's why it's just more, it's a really important time to just really have an effective monitoring process in place to utilize our resources to really, like you as a law firm and our outside counsel, to really just try to better understand this changing regulatory landscape.
Yeah, and do you feel that this is an area where states are becoming increasingly active in response to perceived drawbacks at the federal level, or are those things independent?
I actually do think those go hand in hand. I think when we have a time where there's federal deregulation, or at least perceived federal deregulation, certain states will step in as they perceive a void. And I think that right now we're seeing that in the areas of the true lender doctrine.
Yeah. And as what you've described is a very dynamic environment with, a common law doctrine developing in enforcement and litigation, and then a more prescriptive, aspects of it also developing on a state by state basis. As a company operating in this space, how do you decide what to do and when the rules are changing all the time?
Yeah, so I think there's two parts to this question. So I think first, just how I would like to talk about kind of how we monitor the state legislative legislation, excuse me, and regulatory developments, and then really how we approach it and comply with just the evolving state level interpretations concerning the true lender doctrine. And so for that first part, I think, I think to effectively monitor the developments, it starts with having just a very strong rule change management process. One element that we've incorporated into our process, and I think strengthens our ability to identify this state level risk, and it's not really just the true lender risk, it's other types of legislation that's also coming out. But we have a shared responsibility across the organization. We've encouraged to see something, say something mindset. So team members are expected to flag relevant state alerts, either directly to our regulatory readiness and oversight team, or to the legal regulatory team who ensures it reaches the RO team. So engagement comes from all levels of the company. Even our CEO actively contributes and oftentimes slacks over developments and alerts. This kind of participation, I think, not only improves our monitoring efforts, but reinforces a strong culture of compliance across the organization. In addition to our internal tracking, we're leveraging several key resources. One of the most useful is the AFC's state tracker, particularly because it allows member contributions. This collaborative approach to information sharing helps us quickly identify which proposals are most relevant to our business. We also rely on outside counsel, especially like you, and firms that have established relationships with state regulators, and really a nuanced understanding of the political and regulatory dynamics in specific jurisdictions. This insight is, of course, is invaluable for interpreting legislative developments and assessing potential business impact. And we also leverage tools, we leverage our, certain tools. I think we prioritize leveraging technology wherever possible. So we're exploring the use of AI and how that can help us more efficiently identify and track some of these proposals. And really for the legal team, help us review and analyze some of these developments with the goal of enhancing both speed and accuracy. And so for the second part on, our approach or complying with just these evolving state level interpretations concerning the true lender doctrine, we really take a risk-based approach to evaluating changes related to the true lender doctrine. And for us, our risk assessment is based on data. So in order to properly assess risk and evaluate our options, we start by gathering information from multiple sources to inform our decision-making. So I think when we engage with our teams across operations, products, and other businesses, we're collecting information for them. For example, we may collaborate on exploring different product constructs, and we obtain the data on how those adjustments could affect origination or compliance obligations. We collect information from our outside counsel and peers. And again, we rely on you to provide insights on how the regulator may apply their interpretations to our business structure. So overall, I think it's important to collect as much information as possible to help inform us of the risk. And this really ensures that our approach is not just legally sound, but also practical and aligned with our business objectives.
Yeah, that points to a question that I wonder if you could talk a little bit more about, which is my experience counseling clients on True Lender, especially lawyers or other in-house personnel who are approaching the issue for the first time, is that it can be kind of frustrating in the sense that they just want to know what the answer is. Where are the guardrails? What can I do? What can I do? And this is unfortunately one of those areas where the answer is very complex. It has a lot of nuances, as we're discussing. I mean, in order to form a judgment about it, you can't just look up what the rule is in the Code of Federal Regulations. You have to, do this assessment and information gathering, outside counsel, peer benchmarking, all of these things. How do you communicate to your business personnel about what the implications of True Lender are for what they want to do in this environment that we're in, where not only are the rules changing all the time, but they're not particularly clear in the first place?
Yeah, that's a really good question, because, for me as legal counsel, I get the information from you, outside counsel, and we have these, we talk, and then I got to regurgitate such information to the business and make sure they're informed and they understand. And at Avant, we use several channels to ensure business units are informed about the implications of the state level actions, particularly this year in True Lender. Our general counsel has really done a good job elevating the importance of the issue by including it in company town halls and encouraging our legal compliance and risk teams to present at what we call our demo days. These forums are a great way to engage, I think, the business stakeholders and to contextualize legal developments within the company's broader strategic initiatives. In addition, and back to what I talked about with the rule change management process, we leverage that process to communicate developments on True Lender. When relevant changes are identified and assessed, the impacted business units and their stakeholders are notified, and implementation projects are open, and the channels with legal counsel are also open. So overall, I think it takes a multi-pronged approach to help ensure regulatory developments are not only understood, but factored into planning and execution across the business.
Yeah. Okay. Well, so, to me, the principal concern underlying True Lender and the thing that the states most are trying to protect or enable consumer protection around with that set of doctrines is the cost of credit. The other big lever in state regulation of cost of credit recently, of course, you've alluded to, Sharity, which is the DIDMCA opt-outs. Chava, I wonder if we could turn to you and have you pick up and tell us, a little bit about, well, what is a DIDMCA opt-out? Why does it matter? How does it connect to cost of credit? And what does this have to do with, potential, kind of rollbacks or deregulatory actions at the federal level?
Thanks for the transition, and as Sharity mentioned, I think it's common for folks, especially in the bank fintech partnership space, to be monitoring both true lender activity and now DIDMCA opt-outs kind of as simultaneously, because that's how they're being introduced and talked about at the level of the state legislature. They're often, I'll get into a little bit what, as you asked, what a DIDMCA opt-out is for folks in the audience who might not be following this issue as closely. But it's often packaged together with true lender laws or other types of consumer protection laws aimed at short-term or higher cost lending and lower dollar, higher cost lending. And it's sort of all packaged together as like this is a multi-pronged state approach to try to pull apart what states feel they would like to protect consumers against, that they feel is some sort of a threat from a bank fintech partnership model and online lending. And so the true lender approach is to try to get at using state enforcement against the fintech and saying, well, it's really the fintech who we as a state can govern that's making these loans. And so we're going to go after that fintech and we're going to say it's the fintech here who we can regulate and we can forget about the bank. But that's not always successful, right? I mean, these partnerships are true partnerships, and the states are not always successful in being able to say that it's a fintech rather than the bank that's truly making the loans. And so the DIDMCA opt-out is something that was proposed as a way to get at this. The states could potentially get at this issue by going after state banks who are partnering with fintechs. And to say, well, all right, if we can't get at the fintech, then we'll get at it through the state bank. So taking a little bit of a step back, I can describe a little bit what DIDMCA is, what DIDMCA opt-out is, and how it is evolving as a tool for states to try to use in their toolbox, trying to sort of push back what they see as out of state lenders coming into their state and making loans to their consumers that states may feel are they'd like to protect against. They made different policy choices than other states. So in 1980, which is where the federal DIDMCA law was passed. Essentially, the National Bank Act, this is a concept that folks may be familiar with, is that national banks have federal preemption under the National Bank Act. That means that there's a good number of state consumer protection laws that can't be enforced against national banks because they're preempted. The federal law governs. So state interest rate regulation is an area that has traditionally been preempted for national banks under the National Bank Act, but not for state chartered banks. And so in 1980, DIDMCA legislation was introduced. This stands for the Depository Institutions Deregulation and Monetary Control Act, and I'll forget about that and just call it DIDMCA now. And essentially that legislation was introduced to try to put state chartered banks on an even playing field with national banks, and to say that also state chartered banks no longer have to worry about the interest rates that govern in all of the 50 different states. They only have to worry about the interest rate in their home state. That's the interest rate that they can lend at nationwide. So starting in 1980, state banks and national banks could lend cross country nationwide at just one uniform rate, whatever the rate of their home state was. And so in a bank fintech partnership model, whether it's a national bank or a state bank, whatever is the home state of the bank that the fintech is partnering with, that's the rate that can be lent at nationwide. But there's a tweak in the 1980 law that provided states the ability to what's known as opt out of this interest rate parity. And it was little known and little used for all of 40 years. At the beginning, when DIDMCA was first passed, a number of states, a handful, passed opt-out laws where essentially they said we want to opt out of this federal interest rate parity. But most of them opted back in. And so there's only Iowa and Puerto Rico that stayed opted out, and we didn't really hear much from them for many years. A few years ago, the concept of opting out of DMCA was introduced as, well, okay, here's a new idea. Here's how states who are trying to protect their consumers from out-of-state loans, here's a way that you might be able to protect your consumers. You can pass a law that's called a DMCA opt-out law, opting your state out of federal interest rate parity for state chartered banks located outside your state. And the thought of states passing these opt-out laws was that if your state opts out of interest rate parity, then when your consumers are looking to enter into loans, if they're entering into loans from banks that are chartered outside of their state, well, if your state opts out, those out-of-state banks are going to have to follow the opting out state's interest rate laws. That was the thought behind a state like Colorado, which was the first state in the modern era, well, calling modern now, to pass one of these DMCA opt-outs. Colorado thought, if we pass this opt-out law, we're trying to go after fintechs under True Lender. That may or may not work, but now we're going to try to go after the state chartered banks with whom they partner. And we're going to say they have to follow our interstate laws because we have opted out of the federal DMCA law. As Phil mentioned, that law was immediately challenged in litigation. Full disclosure, our firm and then myself specifically are one of the attorneys on the team challenging that law in partnership with AFC. And we've had success so far at the district court, where essentially the lawsuit that we've brought says, hey, that's actually not it's not what the DMCA opt-out means. It's narrower than that. It doesn't mean that a state that opts out gets to tell all the other states, we can control your bank's interest rates. All it meant was, all the opt-out means is that a state that's opting out can control the interest rates for its own state chartered banks. Its own state chartered banks can't access a different federal interest rate. And so that litigation has been successful at the district court level, but other states have sort of latched onto this idea too. As Sharity had mentioned, it's sort of like alongside True Lender legislation as some sort of means of getting at, trying to control out-of-state banks lending to consumers in the opting out states. So last year there was a spate of state DMCA opt-out legislation. This year, I believe there's still legislation pending in Oregon, Rhode Island, and Washington, D.C. And I know AFC has been working, at the state level, trying to talk to legislatures about, especially educate them about what's going on in the Colorado litigation, that maybe these opt-outs are not doing what they think they are doing. Because a key part of that is they don't affect national banks. So if you have a bank fintech partnership model where the bank partner is a national bank, a DMCA opt-out can't affect that bank. It can't control those interest rates. And the education, I think that AFC and other partners are trying to do right now at the state level is to try to emphasize this argument that we have made in the litigation, which is that a DMCA opt-out doesn't actually do what an opting out state thinks. It's quite narrow. It really just gives that state the ability to have a little more control over its own state chartered banks. It can't allow the state to reach out to the banks that are chartered in other states. Yeah.
Oh, yeah, I was just going to say, well, some of what you've described, Chava, rhymes with what we were just discussing in the True Lender space, which is you have legislation that's been passed or is pending in a number of different states. Plus, you have ongoing litigation, which you haven't quite gotten to this point yet, is currently pending before the 10th Circuit. So this is another area where we've got a varying set of dynamic rules and ongoing litigation. Sharity, that just leads me to ask you this same very practical question again. How do you advise your client about product development decisions, for example, in a context that's so fluid and dynamic and uncertain?
Yeah, that's a great question. So I think it, goes back to the risk-based data-informed approach I mentioned earlier, but also planning for an unfavorable outcome. So as we think about like the Colorado DMCA litigation and whether it's Avant or another entity in the card space, I think it's important to already have evaluated the Colorado credit code and general purpose credit card exemption and whether you would elect to utilize that exemption, and if so, to build a strategic business plan. In my opinion, the exemption contains language that requires careful legal interpretation, and where I would arguably say the regulator hasn't provided clarity. So I'm finding it important to work with with outside counsel and people like you all to gather insights and to assess the risk associated with the various interpretations, and to cross collaborate with our business partners to understand the implications of each interpretation. So overall, our guidance to the business in navigating this period of regulatory uncertainty is to have a strategic contingency plan that is ready to be implemented and operationalized swiftly in the event of an unfavorable litigation outcome.
Yeah, interesting. Chava, is there more to round out the DMCA situation?
I mean, I think that it's similar to what's going on in the true lender landscape, in the sense of that you've got a patchwork of things going on within litigation that you need to monitor, and things going on within other states trying to regulate. I think the thing to round out what's going on is as you mentioned, Bradford, we're waiting for a decision from the 10th Circuit Court of Appeals on whether the DMCA opt-out is really just a very narrow way to get at this. But that's just one, Federal Circuit Court of Appeals. And if you think about the other states where DMCA opt-out legislation is pending, some of them may be watching to see what the 10th Circuit does before they move. Others may not care. So if you think about a state like Oregon is in the 9th Circuit, the 9th Circuit, there might be an assumption that the 9th Circuit would take a different approach than perhaps the 10th Circuit on an issue like this. And so there may be states that actually don't even care to wait to see what the 10th Circuit does before moving ahead and saying, look, we have a tool in our toolbox, we're going to use it. And so, like Sharity is saying, that the choice, in terms of compliance is, well, do you try to operationalize what might start to be popping up as, a multi-state, different interest rate approach, and which is really a difficult compliance consideration, when the whole idea behind entering into a bank fintech partnership model, right, is so that you can have that consistency and not have to be concerned about 50 state regulation, at least in the area of interest rate regulation.
Yeah. This is actually an example of an area as well where the federal policy has changed. Do you want to touch on that briefly? Just in terms of the, policy positions of the relevant regulators?
Oh, yes. It's like DMCA is a state level issue. No, that is correct. When an interesting component to the litigation was the FDIC had actually come in at the district court level with a brief supporting the state of Colorado's position. When the administration changed, it was right around when the appeal was pending in the 10th Circuit Court of Appeals, and the FDIC decided to withdraw its amicus brief. And so the FDIC, on paper, is no longer supporting the state position. The federal regulators have been a little confusing over the years in terms of their position on how to interpret the DMCA opt-out. It just hasn't been necessarily directly addressed. But most of what the FDIC had said over the years in regulatory opinions and other guidance since DMCA and the opt-out had passed, I would say is much more in line with the position that AFC and its partners have taken in the litigation, which is that the opt-out is fairly narrow and really only applies to loans that are made in the opting out state by banks that are sort of really operating there, whether chartered there or have set up key operations there. The OCC has said, similar things, although, they don't govern state banks in the opt-out, but they have released regulatory interpretations that are a little bit more in line with that. So I would say that the weight of federal regulatory opinion has, for the most part, been with the position that that banks and fintechs have been taking in the Colorado litigation. Changed a little bit in the past administration, and now we're back to a little bit more of a blank slate on that. But I guess it'll be yet to be seen if this is an area that the federal government would want to step back in and say something on. I mean, if folks recall last time around on True Lender, we had an OCC True Lender rule that would, provided a lot of clarity for a few minutes.
Yeah, and there's a pattern here, right? There was that prior, OCC True Lender thing that was repealed at the beginning of the prior administration. States continued to push forward, right? Now we've got the example of the Colorado Dinmica litigation. FDIC was on board supporting the state of Colorado. They've pulled back. Colorado is continuing to press that case in the 10th Circuit, and will take it as far as they can. There's another example that's a little bit less relevant to this group happening in New York. The New York Attorney General brought a Regulation E case, EFTA case against Citibank related to wire fraud. The CFPB was hand in glove with the New York AG supporting that case. After the change in administration, the CFPB withdrew its support of that case. But of course, New York continues to press its theory in the Second Circuit now. And I assume will continue to press it as long as it can. So, this is definitely one of those areas where, one of several areas where amidst a federal pullback, you nevertheless have the states continuing to press their case. David, maybe that's a good transition to our next topic, which is earned wage access. Obviously, as many people will know, the CFPB rescinded its 2020 advisory opinion, I think it was, relating to earned wage access back in January. At approximately the same time, of course, California finalized its EWA regulations, and there's other state activity going as well. Do you anticipate that the states will continue to press their case on earned wage access? And if so, what will be the mechanism through which they do that?
Yeah, thank you. Yeah, I do think the states will fill the void from the federal side. We saw this happen during the Trump 1 administration, where, as the federal government pulled back, states began to step forward. And I'd go back even further before the CFPB. States had a robust regulatory scheme for dealing with all manner of kinds of financial services that were particularly not, chartered bank services. So I think the states are well equipped in a lot of ways to step in and fill the void, do so in a way that, if you will, balances more effectively innovation on the one hand, inspiring it, motivating it, helping it, and consumer protection on the other. And so I think there's a lot of opportunity for states. And then the states, there's, for me, fundamentally three different ways the states activate on this. One is legislatively, which my own personal preference is legislatures legislate. Second layer is regulators, and by definition, to me, that means regulators interpret laws and create regulation around them to help businesses to be able to comply with those laws, and again, to ensure consumer protection. And then third is enforcement. And there are really ultimately two forms of enforcement. One is through the prudential regulators themselves, sometimes, and the other is through attorneys general. That's the area where I think historically, when the federal government pulls back, you see greater emphasis. I think we're already beginning to see that now, not just EWA, of course. And what I'd sort of like to do is, in answering, part of the question, or part of what's underlying the question, in some ways, it seems to me, is, all of this is really interesting and challenging for member companies in AFC, for example, and others, who are really trying to live in this intersection between responsible innovation and consumer protection, which for me means looking back at why fintechs exist. All right, fintechs exist largely to fill gaps in the system. Right, we have far too many unbanked, far too many consumers who cannot be served by the existing system, and so you have companies who take the opportunity to try to find ways to serve those customers, and frankly serve the banks, gives the banks access to customers and innovation that banks are not traditionally great at achieving. And so in these places where we have lots of uncertainty, one, it makes it more difficult, right, to serve customers. It adds costing complexity. Like, Chava, to your point, like having a scenario where you might have to be advising your customer, your client internally, your product development people, hey, we may need 4 or 5 different models of this particular product in order to serve in all of these different kinds of states. Adds cost and complexity, particularly challenging in an environment where there's lots of pressure to restrain cost to the consumer. And so again, it's just part of that tension, but I think there's a lot more activity that we would expect to see over the next few years. My hope is that activity includes a lot more discussion and a lot less regulation or legislation by enforcement.
And do you think we're trending towards or will arrive at a place where EWA is expressly regulated as a credit product, either at the federal or at the state level?
My hope is not. That's my official answer. I do believe, as the member organizations in AFC believe, that we have to have prudent and reasonable regulation of EWA. But that means not treating EWA as though it is something it is not. In my view, that means it is not a loan, doesn't have the characteristics of a loan, has some characteristics to be sure, but that it needs to be regulated as its own thing. Now that solves, for me, it solves a couple of different challenges. One is you keep bad guys out. You keep out the people who would want to be predatory, who would want to take advantage of consumers. You set up a framework and a set of guardrails, to borrow Charity's word from earlier, that become very helpful for consumers and businesses alike, where you have clear guardrails that say, yes, these are the places where we're comfortable with people operating and serving consumers. I think it's a lot easier for everybody involved. So anyway, I think it's definitely going to be, more intense working on this stuff. We have legislation pending in a lot of places. The industry has a model piece of legislation. It has been adopted in 8 states or by legislatures in 8 states in some form or another, not always exactly in its original form. There are bills pending, I don't know, in 12 or 15 states at the moment. And I think there will be, sort of more wide adoption of regulation of EWA, but not generally speaking as credit. Even in California, where we after a long set of discussions last year and before that, the regulatory environment shifted. They came up with a rule that says that earned wage access is a loan, is credit, but we're not going to treat it fully like credit. Which, credit to California, recognized the difference between this product and what we would call sort of traditional credit or lending type products. And so I think there's more opportunity there. Again, we think calling it credit makes it more challenging, for consumers to understand the product and the environment in which it operates and what it does do and doesn't do. And so we're hopeful that more states will continue to adopt this other approach, which says, yes, let's 100% regulate it. Let's give it the same kinds of controls and guardrails, for example, that loan servicing or money transmission have, but let's treat it like what it is, which is something different.
Yeah. Well, even speaking of EWA in terms of it or the product, glosses over what has become a quite varied marketplace for a group of similar but definitely different financial services that are targeted at the same issue. And I think the biggest divide is probably, is the EWA service something that is provided, to the employer or through the employer to the employee, so that it's a kind of a B2B relationship with the provider and the wage payer, or is it a direct consumer model where the employer is not, kind of a principal in the transaction, rather the relationship is between the EWA provider and the payee of the wage recipient. Do you see a material difference between those two in the way that states are evaluating this regulatory construct? And do you think we will end up with states treating them different differently or similarly?
Yeah, it's a great question, Bradford. Thanks. I think there are a lot of people who aren't in the business and who aren't consumers, who would like to treat them as very different things that are regulated in different ways. And as we see this come up with bills periodically, the fundamental reality is these products are similar enough, close enough in terms of the way that they operate and the benefits that they provide to consumers that they ought to be treated as one thing. In the model bill, we do make some distinction between the two. And even within these two different constructs, on the B2B side, there's at least two different flavors. There's the ones that are embedded in the payroll system, right? That tie directly to the employer versus to the payroll provider is the second kind of angle there. And then there's, as you said, the D2C. There are benefits to both, right? If it's embedded in the payroll system or in the employer system, you're either using the employer's money or, right, you're using somebody else's money, but consumers see it in their paychecks. They see in the scenario where it's a benefit type, like your insurance provision thing, right? They see the money come out as a benefit payment. There's certain benefits to that. The benefits in the B2C or D2C universe are a little bit different. For example, when you don't have the relationship with the employer, the consumer in some ways has greater optionality. And we happen to know this in my particular company, EarnIn, where we have consumers who've told us that they were pleased that they weren't stuck like with one particular employer who happened to offer EWA as a benefit. And on their next job, they were having to choose, do I want this job in part because it has this benefit or does it? And so it's portable. It gives the consumer greater optionality and flexibility in that way.
Yeah, or they may work for Uber, DoorDash, and Lyft simultaneously, right? And desire to access all wages from all three.
That's right. And listen, even that whole ecosystem, with occasional workers and that marketplace has demonstrated, right, that workers really do want access to their funds. And here I'm going to be careful how I say their funds, because I think this is one of those things that's too often misunderstood. When people work, they've earned the money that is due them. It's only a question of how long before they get that money, right? In the traditional ecosystem, the employer gets a 0% interest loan from the worker until payday. In this other universe, right, where you can get paid daily, effectively, and Uber and Lyft in particular, right, and other similar services have done this, right? They'll collect tips, for example, till the end of the day, and then pay the service provider. And some of those service providers, some of the, again, using our service as well as others, will make choices about how long to work in a particular day. Like if I have an expense coming up, and this is a legitimate true story, I have an expense coming up today, I know I'm going to get paid this afternoon, I'll put in a couple of extra hours so I can do the thing I want to do tonight. And so from my perspective, again, it's part of this is giving consumers choice and optionality, flexibility that they don't have, under a system that pays every 2 or 4 weeks or every month.
Yeah, and so pivoting slightly, David, you at the beginning of your remarks talked about this preferred hierarchy of legislation, regulation, and guidance and enforcement. What are you seeing at the state level across those three buckets? Is one ascendant? Is the other ascendant? Are they all playing a role? What's happening?
Yeah, fair question. I think it's all happening at once in one way, which is job security on the one hand for me, is a cause of great discomfort for my employer.
Yeah.
There's the private plaintiffs bar that has its own sort of unique spin on a lot of this stuff. In some ways, it seems to be that those folks take their cues from publicly filed investigation or publicly noticed investigations or public filings from attorneys general. But there are certainly, attorney general cases pending in the area, a number of consumer class actions pending in the area, and all in one way or another, charitably said, trying to seek clarity, right? So for those folks who are on the plaintiff side, they're trying to seek the clarity that EWA is alone and should be treated as such under the Truth in Lending Act, among other things. And we who are defending those have the opposite view, right? It is not alone, should not be treated that way. And oh, by the way, let's have the legislatures and the regulators sort out what this really is or isn't, because they're better situated than the courts to make these decisions.
Yeah. Yeah. Okay. I want to just make a note for the audience. We are coming into the last 15 minutes of our session here. We have a few additional topics that we will talk through and discuss, but I do want to remind everyone of the opportunity to ask questions. And we do have, we would love to receive your questions and have an opportunity to speak to them. We do have one question from the audience that I want to address, which is, you know, and this is enforcement related, in the context where, given what's happening with the CFPB is the way the question is posed, what powers do the states have to regulate? What is and isn't preempted? So I'll maybe get us started in answering this question, and I would love to hear from others. I think the short version of this, particularly for entities that are not national banks, but even for national banks, is that states have very broad power to bring enforcement actions in the context of consumer protection. The principal limitation is no one state regulator tends to have a good claim to a nationwide group of consumers, but the state regulators and state AGs are increasingly sophisticated in coordinating their efforts. They meet regularly, they discuss priority enforcement cases. There is a diaspora of CFPB enforcement attorneys that is forming, spreading out across the country and staffing these agencies. They will have even greater relationships than the regulators currently and AGs currently do, which I think will increase the likelihood and sophistication and frankly efficiency of multi-state actions, which will to a significant degree render them more nationwide in character. In addition, the state AGs have the authority to enforce not only their state unfair and deceptive trade practices statutes, but they also have the power to enforce the federal Dodd-Frank unfair and deceptive and abusive acts and practices statute, which is an additional tool in their toolkit, which they have been encouraged by the outgoing CFPB leadership to use, and which some of the state AGs have experience using. I expect, again, as the CFPB personnel fan out into these agencies, that we will see a greater degree of enforcement of Dodd-Frank UDAP by the state attorneys general. The other thing that I would say is, these entities have the ability to conduct investigations. They cannot supervise national banks, but other than that, they have very broad and powerful subpoena power and can conduct investigations pursuant to their law enforcement authority or their financial regulatory authority in the case of the regulatory agencies. So, they very much remain a threat, and in many states, have already begun to show the muscle that they have in these areas and the way that they can carry out really big, impactful, material, nationally important enforcement initiatives. And I think we will almost certainly see more of that in the coming years. Do other folks have thoughts in response to that question?
The second part of it, what asking about what is and isn't preempted, I think is like you were saying, Bradford, there's in the realm of consumer protection, fair lending, things like that, there's not a lot of there's a lot that states can do, and they don't need to worry about preemption. But the other part of that too is with the broad investigative power, there can be places where a bank that might wish to claim preemption might think about pushing back and claiming that there should be preemption, even though their state says there isn't, but because they don't want the publicity, right? The way you can push back is you might need to bring it to court. But if a lot of banks may decide, well, financial institutions that are federally regulated and think they have a preemption argument might choose not to push that with the state in the favor of keeping the investigation confidential and hopefully arriving at perhaps a confidential resolution, or even if it's a public resolution, right? Trying to get it done without forcing the issue of preemption. But the other point about preemption too, is just that there's still a lot that we're watching in terms of figuring out what's preempted. We have certain things that are specifically preempted under federal law. So that would be like the interest rates, you know, that we were talking about with the National Bank Act and DIDMCA, with this like opt-out wrinkle. But then, you know, we had the Supreme Court's decision in Cantero just recently, right? And we have two circuits now reconsidering a state issue, whether a state can mandate that banks have to pay interest to consumers on residential mortgage escrow accounts. You have the Ninth Circuit saying one thing, and you had the Second Circuit saying another, and you have the Supreme Court telling them, well, go back and think about it again, not giving a clear answer on whether that one type of state law is preempted or not. And so in realms where you have to have a preemption analysis to try to figure it out, it's hard to give an answer, but it's something to keep a close eye on, because as states might be swooping in to fill the void, preemption is sometimes a tool with which at least a national bank can fight back. But it's often really not clear cut enough to be, you know, to sort of say, yes, this is preempted, this is not preempted.
Mm-hmm.
Yeah, let me chime in with perhaps something of a geeky thought here, which is, yeah, I have the utmost respect for the framers of the Constitution, and the idea that there is a realm where the federal government should be able to preempt and give sort of equal balance, if you will, so that people can operate in a multi-state fashion. Preemption on something like TILA, for example, makes perfect sense to me. You have a federal law, let's have one federal interpretation instead of 50 state interpretations of what TILA means and what it covers and what it doesn't. There are other places, you know, where it makes absolute sense that, at least from my perspective, that the laws would be narrowly interpreted or addressed on a state-by-state basis, where, you know, at least theoretically, there's a choice for people about, do I want to live in a state that has this set of laws versus a different set of laws? But again, I would sort of highlight that in the places where there's not a clear national standard, it does drive up the cost of doing business, which means it drives up the cost to consumers for having access to the services they want and need. And I think that is far too seldom talked about in the sort of the broader policy construct, is like, really, what is the impact on consumers from this kind of behavior?
Yeah, you know, one issue that's percolating that I think gets to, you know, very much highlights some of what you've discussed, Chava, and David, some of what you have raised as well, is the first effort at state level regulation of interchange fees. You know, many in the audience will have business models that are built in significant measure on interchange revenue. And up until recently, interchange fees were either not regulated or they were regulated at the federal level only on the debit card side. Illinois last year passed a law with very little consideration, in my view, purporting to regulate the interchange fees that can be assessed on gratuities and Illinois taxes. Well, the card payment system, to me, is the absolute picture of a nationwide, highly interconnected, complex system that needs to work with one more or less uniform set of rules of operation. And this Illinois law really seeks to upend that and add a lot of complexity and, of course, change the economics of the payment system. That case is currently being litigated. You know, again, Chava and I are involved in that in some respects, although not as litigating counsel. And the district court has now found that Illinois state law is preempted as to many entities, but not all participants in the payment system. That has injected an enormous amount of uncertainty and is, you know, driving cost and complexity as the effective date of the law approaches. No question. However, there, I think, are bigger stakes in that case, because it ultimately is going to make its way to the Seventh Circuit, almost certainly, and maybe beyond. And what the Seventh Circuit or some higher court will determine is, well, do states have the ability to regulate interchange fees? And if the answer to that is yes, we will not be in a world where the only state interchange regulation is taxes and gratuities in Illinois. Rather, states will see an opportunity to regulate interchange fees more broadly. And then we will go from having a well-functioning, federally regulated system to a system that is much more patchwork. And I think that will be to the advantage of everyone in the system, except maybe the merchants who are the ones agitating for this legislation. I think it's interesting, by way of brief aside, that fight is happening in Illinois. Dick Durbin, of course, who is the mastermind of the Durbin Amendment, which led to the regulation of debit interchange and Reg II, which was implemented by the Fed. He's been a thought leader on interchange for his entire career. He just announced this week that he's retiring. And of course, Jay Pritzker has also made it quite clear, the governor of Illinois, that he aspires to be president. So there are a lot of cross currents happening in Illinois politics, and it makes me a little nervous that we've got a piece of financial regulatory legislation that's may create some opportunities for people who want to get attention in that jurisdiction. So an item to watch for sure.
Yeah, ironically, not unlike the old convenience fee battles, right? Where my favorite story in this, I'll make this one short, is in some states you can charge a rate for credit card purchase on gasoline, and then you can charge a discount for cash. In other states, you do it just the opposite, right? Where you charge a base rate for fuel, and then you can charge a surcharge or a convenience fee for credit. I don't personally know who any of that stuff helps. I think it just adds confusion and complexity.
Yeah, I have a question for you from the audience, David, but the gas station closest to my house has an enormous illuminated sign showing the cash price and the smallest non-illuminated sign imaginable showing the credit price. You really can only notice it if you were looking behind the bushes, you know what I mean?
That's right.
So yeah, it's not helping. In fact, it's causing confusion. There is a question in the chat that I want to pose to you, which is there an effort among the EWA firms to develop a coordinated federal policymaking strategy to hopefully implement a rule or some other form of guidance statute at the federal level that would, preempt all of this potential state regulatory activity?
Yeah, I think it's fair to say partially yes. Like there's an effort to work together on a federal bill. Representative Style out of Wisconsin floated a bill last year that most of the industry was supportive of. Got some feedback, and a number of us have been working with House Financial Services staff and others to try to refine that bill. And again, the idea would be try to get a federal standard for the things that give certainty across all states, not to restrict, for example, the state's ability to still supervise or still regulate with licensure, which is a feature of our state model bill, which again, we all sort of support. And so I think if we could get to federal clarity on that and use that as a vehicle for doing so, obviously it's very difficult to get anything through Congress these days, especially with the effective 60 vote requirement in the Senate. But there are those of us who are very hopeful that there's a rational ground that we can all kind of get to. May not be today or tomorrow, but hopefully in the next couple of years.
Okay, awesome. Good. Thanks for the questions, audience. We've got just a couple of minutes left. Chava and Sharity, I want to give you an opportunity to give any last remarks since you haven't had the talking stick in a minute. Sharity, you're a little fuzzy,
you're blurry,
but
Sharity.
love to hear from you.
I don't know what happened. I guess I was quiet so long the screen just got tired. Yeah, I guess just some, final thoughts are, I think just utilizing our resources to monitor this, ever-changing landscape. And I say resources, but, sticking with you all, our outside counsel, I also think it's just important. And, we're here at an AFC webinar, but I think it's important to emphasize being involved in the trade association. I think this has really helped us, going back to the true lender doctrine I talked about. I think engaging with the AFC has also helped us stay on top of it and be involved and participate in the activities. And so we are doing our part to, for lack of better words, combat what we see as a threat to the business and the overall bank fintech model. So staying active and monitoring, I just think is important. And the last words I'll leave you with.
Awesome. Great. Chava, anything to wrap us up?
I did see another question in the chat that could have been directed at what I was talking about that involved Didmica. It's not really a wrap-up question, but in the 1 minute I have, I would feel bad if I didn't address it.
Go for it.
The question was, with Iowa and Puerto Rico opting out of Didmica, does anyone know if out-of-state state-chartered banks have had limited or no operations in those territories? Two quick public pieces of information there. Puerto Rico actually doesn't really have any significant interest rate regulation that would inhibit anyone despite a Didmica opt-out. So I think that's probably the situation there. Iowa had an assurance of discontinuance, meaning a consent decree against an out-of-state bank fintech partner deal, but I have been actually under the Didmica opt-out, but I have actually been told that they have taken that down from their website. So the regulator view of their opt-out may potentially be changing. Interesting.
Wonderful. Well, we want to thank everyone who joined us this afternoon. Your time is very valuable, and we appreciate you spending some of it with us. If you have any questions, for the panelists, the AFC host can connect you with us. And have a great afternoon.